All right. I think we're good to go, and we'll get off and running. I promise we'll still get you out of here at half past the hour. So welcome to our first quarter update for 2023. I'm Brad Long, partner and deputy chief investment officer here at Fiducient Advisors. I'm joined by Rob Lowry, our associate research director, and he and I are going to spend really the next, call it 20 minutes or so, going through three things: kind of the what, the why, and the how. What happened in Q1? Why, most importantly, was it happening, and kind of what's the trend underneath the hood? And then the how. How is it impacting our view going forward for 2023 and really beyond? For maybe just for administrative purposes here, if you have questions, feel free to put those in the queue. We'll try to get to them throughout and spend a little bit of time on them on slides that we might have already prepared. If we don't have an obvious spot to get to it, we will try to get to it at the end. And then if we can't get to it with the number of questions, don't worry, we can easily follow up with you and make sure to get to it. Our lawyers aren't able to join us here today, but we do have to have our disclosure slide up here for a prerequisite amount of time, which I think we've checked that box on. So why don't we jump straight into it? So 2023, for those that are kind of new to our content, if you will, we really walked into the year with three primary themes that we thought would be influencing market and market outcomes. So those are persistent volatility, moderating inflation, and a bear market bottom. And so in very quick fashion, persistent volatility, it's not just taking the volatility of 2022 and applying it to 2023, but it's this notion of, as we leave this environment of kind of zero bound interest rates, and we move into an environment that has materially higher interest rates, that's going to lead towards greater volatility of individual asset classes. It's going to lead towards the more importance of the interaction between asset classes. And so asset allocation and many other risk mitigation factors are going to apply. And we're really going to revert from this period of abnormally low volatility into a period of higher volatility. Moderating inflation is a key theme that we have coming into 2023. We don't think we'll solve inflation per se in 2023, but we do think we will be on and are on a credible path towards lower inflation. That has an important inference of what the Fed might do with the federal funds rate, which is obviously very relevant to our final theme here, which is a bear market bottom. And as we mentioned earlier in the year when we went through these kind of in much greater depth, we don't have the power of precision on a bear market bottom as it's going to happen April 11th today or July 15th or any other time in the future. But without the power of precision, we're really using the power of preparation and preparing portfolios for what we see as kind of some of the key themes coming through here, and that 2023 in aggregate is a better year to be adding risk capital or preparing for the upside than 2022. And so, as we look at these kind of themes and unpack them in just the first quarter here this year, we'll really spend a bit of time talking about kind of what's been driving behind the scenes. So jumping into 2023 in just the first quarter, here's a quick snapshot of really what happened across markets. Blue bars here are fixed income, gray bars are equity, light blue bars are real assets across the board. And you can see there's quite a bit of green on the screen, proverbial green on the screen, I guess here, and markets have been moving to the upside. But on the macro, on the high level, there's been a lot of mixed macro messages, I guess is a good tongue twister to kick us off. On the positive side or the bull market side, there was a lot of strong economic data that came out in the first quarter. So we added 517,000 jobs in January and 311,000 jobs in February. At least January, that certainly surprised to the upside. Retail sales for January came in at 3%, which is well above expectations. Usually after higher spending in the fourth quarter and kind of the holiday season, you tend to see those dip. Same thing on the job side for January. And so, that has certainly been one of the things the bulls have been talking about, is the resiliency of the economy. And then in February data, January information, unemployment hit 3.4%. That's the lowest unemployment rate we've seen since May of 1969. And so we're going to spend a little bit of time, unpacking kind of what those mean today and how those influence, our opinion of those themes and opportunities going forward. On the bear side, clearly, we had a crisis of confidence creep up at the end of the quarter. We'll spend a little bit of time unpacking that. In short, as SVB, Signature Bank, and a number of other regional banks really came into issues in the beginning of March, that really instilled a lot of concern across markets. And there was somewhat of this almost PTSD from the global financial crisis. And, what's the next shoe to drop is this systemic risk. In short, on that end, we think the Fed, the Treasury, and the FDIC frankly did a pretty extraordinary job and seem to have learned from lessons from the GFC and building out the term bank lending facility, which occurred really over the weekend after SVB went into receivership with the FDIC, and created quite a bit of liquidity for the financial market or for the financials to make sure that they can address some of this crisis of confidence. Now, of the 4,700 banks in the United States, does that mean that there will be no bank closures going forward? Probably not. But does that mean that we have this kind of massive systemic risk, especially with some of our largest institutions in the country, which kind of shake the foundation of the global economy? We would also say that that risk is fairly moderate. But we do certainly recognize that that was something that popped up quickly and has had a material influence on, frankly, the ability and willingness for the financial sector to lend. And that certainly has a knock-on effect of economic growth, which we'll spend a moment in just a second on. So with that in mind, we're going to double click on a lot of these themes here. And we'll kick it off on the fixed income side.
Great. So let's dive into the fixed income markets a little bit more. As Brad mentioned, markets were pretty strong across the board in fixed income, a nice reprieve from 2022. Ultimately, what drove that were lower interest rates, right? The 10-year ended about 40 basis points lower than it began, but point to point, it wasn't smooth, right? That persistent volatility was present in the first quarter. The 10-year bounced from 388 down to 330, up to 407, and then ultimately ending at 348. And a lot of things driving that: strong economic data, higher inflation prints mid-quarter, the banking crisis, et cetera, all impacting what rates did. And if we look at the yield curve in the top left, the yield curve's still inverted, and pretty significantly so. Mid-quarter, it touched the spread between the 10-year and the 2-year was -1, the lowest since, or the most inverted since the 80s. So a pretty inverted curve there, but then moderated as we trended back towards the end of the quarter. Investors tend to think of the inverted yield curve as a pretty good indicator of higher probability of recession. It's historically has preceded recession. When the curve is inverted, that timing is variable and not highly predictable, but nonetheless, the yield curve is showing that higher probability of recession. But if we pair that with the rest of the fixed income market, so if we take the corporate bond market, for example, it's telling a little bit of a different story. Corporate bond market spreads, so the spread above treasuries that investors would be expected to be compensated for that downgrade or default risk, are kind of hovering in that 10-year average. Typically when we see recession on the horizon, spreads really widen out the high yield market into the 700, 800s, 900,000 basis point levels, and we just haven't seen that. Spreads did widen out in March with the banking crisis, but overall has remained pretty muted. So a little bit dichotomy between the rate market and what the corporate market is doing. But overall, we think fixed income continues to have a place in portfolios, and we'll unpack that a little bit more at the end with asset allocation. But interest rates and yields are significantly higher from a year prior. You can see in the bottom right, corporate yields 8.5%, so a good forward-looking return there. The ag yielding about 4.5%. So fixed income remains an important piece of portfolios going forward. Well, let's unpack that volatility in the market a little bit more. And really what drove a lot of the rate vol during the quarter was what investors thought the Federal Reserve would do in terms of interest rate expectations throughout the year. So as some may know, investors can invest in futures to quote unquote bet on a position of what the Fed funds rate will be in the future at various points in time at their various meetings. And what we have on the page here is what the market thought heading into the year, what the Fed funds rate would be in December 2023, so at the end of this year. And using those futures, we get a probability distribution. You can see that highest probability normally distributed right in the center of the page kind of in that 450 to 500 basis point level coming into the year. So really markets thinking, yeah, there might be some rate movements up or down by the Fed throughout the year, but ultimately by the end of the year, we think rates will be kind of where they started. As the quarter moved on, we saw really strong economic data come in, right? As Brad alluded to, really strong unemployment, strong retail sales, a little bit higher inflation print than expected, and Fed language saying, there's still work to be done. And as we got into March, the rhetoric around the market really saw a significant shift in expectations, driving 100 basis points higher for the end of the year, saying the Fed is going to have to raise interest rates by another 100 basis points to really combat that inflation, strong job market having support, et cetera. If you think about that 3/8 date, the March 8th date, that's the Wednesday before Silicon Valley Bank collapsed and the banking crisis ensued. And as markets and investors digested that news and what would happen, we saw a significant repricing in what Fed expectations would be to the opposite side. So showing going down to 375 to 400 basis points for the end of the year, right? Indicating 100 basis points of cuts. And as the Fed and the Treasury and other, came to relief, the banking sector, markets seemed to settle out over the ensuing weeks. And by the end of the quarter, we kind of shifted back gradually towards, where we began the year. So what does this all mean? And I think ultimately, we think with inflation moderating, strong job market, et cetera, overall, the Fed's probably closer to the end of its rate hiking cycle than the beginning. It may move, 25, 50 basis. We don't know the exact terminal rate, but we do think we're closer to the top of that. And what does that mean for markets? It's constructive for markets. We get clarity. Markets can sense that top and should bode well for portfolios going forward. This is, Brad had mentioned, 3.4% unemployment, the lowest it's been since the 1960s. Some of you may be thinking, well, if we've got unemployment so low and that job market's so strong, the Fed has to raise rates. Inflation's still high, trending down. So we took a look and to see if is low unemployment in and of itself, by itself, a good predictor of what interest rates are going to be going forward. And what we found over the last 10 cycles since 1957, we found where the low unemployment rate was around a recession. So kind of 6 months before, 6 months after, what that unemployment rate was. We took what the Fed funds rate was at that low and then looked out 12 months later. We found, in fact, 9 out of 10 times, rates were lower than where they began. So a low unemployment rate in and of itself as a standalone hasn't really been a great indicator of higher interest rates in the past. It's probably a better indicator that unemployment rate is going to go higher if you're at a low, right? But there's a lot of things driving that interest rate movement too. And we touched on inflation. So let's look at inflation a little bit more, trending over headline CPI over the last 12 months, sitting right about 6%, still elevated, no question about it, but well on its way downward from the high we saw in June 2022, right, 9%. But if we think about inflation a little bit more and what that 12-month number is, it's a pretty lagged indicator, right? It takes the last essentially 13 months, right? It gets reported on one lag month, so 12 months prior to that. And that is the year-over-year change. A lot of what we're seeing in this year's number is stemming from inflation coming from beginning of 2022, right? So we had supply chain issues, we had high commodity prices, et cetera. As we look at a more recent trend, right? So we took the 6-month change of CPI and annualized it so we can compare it to the 12-month change. Yes, it's a little bit more volatile, right? So higher highs and higher lows, but we can see that recent trend telling a much different picture and story than the 6% headline level that we've been seeing in the news. So what's driving this, right? We've got commodity prices lower, housing market data starting to roll over, especially on the prices side. And if we look at that a little bit more on the housing front, the largest portion of the shelter component of CPI is owner's equivalent rent. And that's been really sticky. It's a lagged indicator. And it continues to drive up and up and up over the last year. Whereas housing prices, kind of real-time data, Case-Shiller Home Price Index, some of the Zillow indexes out there showing home prices falling as interest rates have come up, just a softening in the housing market. So if we take out the shelter component of CPI over the last 6 months and annualize it, we get, in fact, a really low inflation number at 0.56%. So we're not saying that inflation is going to 2 or 0 anytime soon necessarily, right? But I think with this data showing, and what we believe is that inflation's on the right path. It's trending lower. And as we start to see some of that home price data and owner's equivalent rent roll off from last year, we think that will have a nice impact onto the inflation numbers going forward. So again, what does all that mean? Lower trending lower inflation, markets thinking, expectations being kind of where the Fed is and at the top of the cycle. I think that bodes well overall for portfolios, for markets going forward.
So pivoting from that notion, right, of kind of a terminal Fed rate being nearer to the terminal Fed rate and moderating inflation, that also has a substantial influence in the equity market, as we well know, right? The Fed was the primary mover of equity prices last year with higher interest rates, meaning lower multiples. And remember, stock prices can kind of be split into two pieces: earnings per share, which is kind of the bottom line of what an investor buys, and then how much you're willing to pay for it. So usually some type of multiple of that. So are you willing to pay 7 times, 10 times, 20 times earnings? And so on the upper right here, as we look at valuations, which includes both kind of prices and earnings, we have seen valuations come up over the quarter. And we'll double click on that a little bit and kind of break into where some of those valuations are driving. But the primary reason quarter over quarter the valuations have gone up is twofold. One, prices are higher, which is fairly self-evident. And two, actually earnings have been falling. So earnings have not certainly been keeping up with the change in prices. And so we've seen kind of the green dots here drift above the gray. Now, clearly different valuations level here in the United States versus outside the United States, international and emerging. It's one of the reasons that we've continued to have an overweight overseas for international and emerging markets. But the valuation spread is also, you can see the kind of dark blue ranges there. It's also a lot tighter and higher on the on the US side. Part of that is, you could say, maybe there's a stronger letter of law. Part of that could also be the complexion of the market. In the United States, we have a lot more technology, we have a lot more healthcare, we have a lot more services. Those businesses tend to trade at higher multiples than energy, industrials, or commodity-based businesses, financials. Nonetheless, though, you do see a pretty substantial valuation gap between the United States and outside of the United States, which we'll talk about more in just a moment. On the upper right here, it is worth noting, Q1, and we'll spend a little bit more time on this, pretty massive deviation on kind of winners and losers, if you will. Information technology as a sector up almost 22%, driven by a handful of names, which we'll talk about. And then financials, obviously a crisis of confidence in financials is probably not good for a financial stock. As an index under the S&P 500 down, call it 5.5 or a little more over the quarter. And so that's a pretty large spread between the two, which we'll spend a little bit of time on kind of, breaking down what that means for us. Now, bottom here on the country basis, top 10 largest economies around the globe. You do see the highest bars here: Germany, France, Italy. Those are all developed European countries. And if you kind of take a time machine back and remember, the fall of last year, that was a period in which Europe was really preparing for a pretty cold winter, both literally and economically. Russia has somewhat developed Europe over a barrel, pardon the pun, in regards to energy inputs like oil and natural gas. And so that goes into power production, that goes into heating homes, et cetera. A better winter, or warmer winter across Europe has alleviated a lot of those concerns. And so as we come into spring, you've seen a pretty substantial relief rally there. Germany, a pretty heavy industrial based economy with power input prices meaningful to their economic growth, up almost 15%. But you see the same thing kind of France and Italy as well. And on that end, as we talked about, the differences between, kind of developed international outperforming and US valuations, one of the other tailwinds here, potentially in the future, but certainly has continued to be recently, is the trend in the US dollar. So going back to the third quarter and fourth quarter last year, US dollar was really at multi-decade highs relative to many currencies. At that point, still in 2022, you had global central bank coordination, maybe hold aside China or other, regions in LATAM where you had materially higher interest rates, but the pace and magnitude and difference between the two meant a lot, and so that led to a materially higher dollar. But the Fed, I wouldn't say they blinked, but really they opened an opportunity as inflation peaked in June and then continued its downward path. Markets trying to be forward-looking, saying, hey, maybe that means the Fed can slow here, whereas other regions of the world did not have that benefit at the time. And so you've seen the weaker dollar. And all else equal, remember, a weaker dollar, US dollar, means that any assets outside the United States, unhedged international bonds, developed emerging unhedged, EM, equity, all else equal, that's going to be a tailwind to those prices. And we've certainly seen that continue and could potentially be, at the very least, less of a headwind as it's been over the last 15 years, potentially a tailwind continue to go forward. But maybe as we zoom back into the United States, one of the key trends here in the US was that pretty massive shift, as I mentioned, from back into information technology, away from financials, as kind of that crisis of confidence in banking occurred. What we did here is our lead growth analyst here in the US, Marilyn Rowland, put together this chart, really showing the pretty massive dispersion of many of the bell of the ball names pre-2022, so those, think of like Fang M or others, a lot of tech heavy or long duration growth, stocks that have prioritized growing revenue, not necessarily earnings. As interest rates were rising, that was really painful for many of those positions through 2022. And that's the bottom blue, light blue here. So Meta, which is the parent company of Facebook, down, 60%. You can see Apple, Amazon, Netflix, Microsoft, many of the kind of classic names that were really the success story 2021 and before. Now, for just the first quarter of 2023 is the dark blue lines at the top here, and you've seen a pretty substantial rally. NVIDIA, which is a chip maker, up 90%, Meta up 76%. But even outside of those, just kind of more of the blue chip names, Apple 27, Amazon 22, Microsoft 17. And the S&P in aggregate was up 7.5. So a lot of that outperformance in the S&P really came from those positions. And if we take one step back out of some of these individual names, this is a heat map of really all the stocks in the S&P 500. There's 506 of them, I believe. And you can see some of the biggest stocks were some of the best performers. A lot of green in the upper left here. That's the technology sector, communication services with Google and Meta, Amazon and Tesla. In cyclical. And then, one of these things is not like the other, right? There's a lot of other red on the screen here, through many of these other sectors. And so, as we think about some of that muscle memory of where investors have run to, of the things that have done really well, we provide a little bit of caution there because, as we think about a transition from a zero rate interest environment to something higher, that does have a meaningful impact on these positions. And you can see the NASDAQ 1000, an index that's a little bit more obviously tech heavy, going well above its 10-year average and forward price to earnings. 10-year average is called around 21, trading at 25 times forward. So the question is can these small number of stocks have a repeat performance over the next decade and just continue to outperform? Possible. It's just not probable. So we would caution those that are just using kind of a repeat of the last decade's success stories and trying to apply it today. We mentioned there might be a little concern there. Now, one of the things we do want people to pivot on mentally is moving from just focusing on the Fed to now focusing on the effects of the Fed. The Fed has been the right discussion through 2022, and that is where investors should focus, is what was the direction of inflation? What does that mean for the Fed? As we noted, we think we're nearer towards the end of the Fed's rate hiking cycle. So now we need to talk about, at today's interest rates or maybe slightly higher, what does that mean for businesses in which we invest? And so earnings is really kind of where we think our gaze should shift to in regards to future impact. And, we'll start with kind of some of the good news here. But one of the things that has been difficult for the market to overcome is very rosy future expectations. In 2022, the expectation at the beginning of the year was 2022 calendar year earnings would grow over 10%. As we closed 2022, they grew by, they were just barely positive. And that was basically because they were bailed out by the energy sector. If not, they would have been negative. So overcoming expectations is a difficult thing to do. And even coming into 2021, expectations were largely flat for S&P earnings, down 30 basis points. But now, as we've traversed the quarter a little bit more, we have new information. Forward expectations have actually now reflect, some of the difficulty of higher interest rates and the impact that we can see from those. And so now you can see forward expectations are at 6.6 and just negative 6.6. And just for context, if earnings in Q1 actually come in at 6.6, that will be the lowest since Q2 2020. Now, that was also a period where we were in the midst of COVID. Earnings fell 32%. So, we don't think that that's a mark we're necessarily going to beat on the downside, but nonetheless, that would be a pretty material drawback. But as expectations are moving lower, it's easier to beat. And that is a good incremental step for our final theme, which is bear market bottoms. And just for historical context of kind of where we are in this earnings cycle, peak to trough, earnings peaked here in the United States, July 8th, so we're 267 days in. Now, since 1998, on average, it's taken about 230 days for earnings to go from peak to trough. Now, this isn't economic law, right? There's no need that once you get past 230, it has to, we have to find a trough. This could continue. But again, it gets us back to this idea of we're further along in the economic cycle. We're further along in the bear market bottoming cycle. And as we start to stack some of these things, like the terminal rate of the Fed, as we stack kind of earnings expectations coming down and we get further into the tooth, it gives us an opportunity here to find solid footing on the way down. The final thing we would point out here is, as investors, with markets trying to be forward-looking, we don't have the luxury of waiting for the all clear horn for any of this. We can't simply wait until the Fed is done. We can't wait until we're sure that the earnings have troughed. Markets tend to move about 3 months ahead of earnings troughing. And so, as we think about being forward looking, we have to be very cognizant of that potential risk. So we do think that as we unpack those themes, kind of, continued volatility, moderating inflation, or bear market bottom, that we are making headway on that end.
We'd be remiss just to not touch on the commodity markets. If you remember on the first page that Brad went through, the commodity markets being kind of that sole loan negative returning sector, really driven by the energy sector. And what we saw year to date, that warmer winter weather coming out of Europe, really kind of loosened the stranglehold that Russia has on the commodity supplies in that region, and natural gas prices fell, call it 40% through the quarter. And then oil prices have come down as well, as concerns about, slower economic growth going into the year and continuing through the year, put some pressure there. But on the flip side, volatility picked up and investors went to the perceived safe haven of gold. And gold tends to do well when there's volatility in the commodities market, and gold prices are up about 10% through the quarter, driving that precious metals subsector. On the real estate front, REITs in general as a whole were up modestly positive for the quarter, up about 2.7%. But, pretty strong divergence within, most of the sector is positive, but you can see that really big outlier, the office space down at the bottom. Markets continuing to digest just what's going to happen there. If you remember, remote work was about 60% of the labor force during COVID, peak COVID. It's trended down to about 30% now in that hybrid remote environment. We go pre-COVID, it was 4%. So, there's a pretty big gap between 30 and 4 and what the office space and what occupancy will look like going forward. The banking sector and uncertainty there as well, obviously having a big impact on office. There's a lot of connection and leverage within that space too. So overall, real estate positive, but office a big standout negative.
Sorry, I muted. So to wrap here and to get to some of the questions that we weren't able to get to in the queue this far. So where does this leave us in our outlook, right? So we've talked about the themes: continued volatility, moderating inflation, bear market bottom. We think those very well stand and will continue to be important drivers of market outcomes in 2023. As you can see on the chart here, somewhat intuitive. Green arrows up, we've been adding capital to those spaces. Red arrows down, we're removing capital from the spaces. And these are things we did in preparation, coming into 2023. So, Rob mentioned kind of duration outperformance, and that was a position, that we put on because of the higher yields within fixed income, and the opportunity or potential for greater volatility. So with higher yields, fixed income kind of restores more of its historical position of a diversifier from equity, as opposed to what it was in 22. It just sold off in sympathy with, and that position was largely funded from kind of reducing some of our dynamic bond exposure, which has a lot less interest rate sensitivity. On the U.S. front, taking advantage of kind of relative valuations and change in leadership in small cap. In Q1, that underperformance was really driven by the regional banks and larger exposure to financials and small cap indices relative to large cap, and that outsized success of some of those large tech companies, as we mentioned, kind of the NVIDIA, Tesla, Metas of the world. But that's a position that we still think, makes a lot of sense in going forward. So in short, as we enter the year, putting on those positions and kind of where we view primary themes driving markets, we think those are still very well intact and haven't shifted materially. But why don't we try to comb through some of these questions here that were coming in that just didn't naturally land on some of the slides that we hit on. One of them was, do we see parallels between the LDI crisis in England last year and the regional banking issues that we saw this year? In short, the answer is no. A lot of the issue that came through the LDI crisis in 2022 was kind of leverage on leverage, right? These were leverage positions that were added to try to extend duration and maybe overmatch or try to match long liabilities on the pension side. So it was a function of trying to over-engineer, frankly, a very burdened pension system. Then you also had on top of that kind of a crisis of confidence, and maybe that's where the two connect, of a change in central leadership. Obviously, leadership has changed in the UK. Windows were created to kind of exit some of those positions that were over-levered, whereas the regional banking issues, again, maybe the connection is kind of the crisis of confidence, but the concerns are really more on liquidity of those underlying banking systems relative to the loans that they've made in the past. And so, I think that there's, maybe you can draw some connection between some of the words or catalysts, but there's really not a strong connection underlying the two. Let me comb through some of the final questions here, and we'll make sure to be cognizant of time. I think we've probably gotten to the rest of these, and in the interest of time, since we started a few minutes late, we entered a few minutes late, apologies for that. If there are additional questions that we didn't get to, we can certainly follow up with you. But one, we very much appreciate your time and logging in today. If there's anything that's specifically relevant to you that we didn't hit today, please feel free to reach out to your advisor. We're happy to chat with them and certainly follow up with you. We'll plan to do this again next quarter. That will also be our mid-year outlook. So we'll have a more formal check-in on kind of those themes and allocations and capital market assumptions. But thank you so much, everyone, for dialing in, and we'll see you next quarter. Bye-bye.